Firstly, I want to read the legal disclaimer. So, FMRE Real Estate, we are a buyer's agency, and our associated entities take no responsibility and disclaims all liability against any losses, damages, or costs as a result of use of this information today. Now, we put together a lot of information that just recently come out of the inflation and so forth. So, you'll see some data around it that basically has been condensed into giving a right message tonight. But please strongly feel that you should be seeking your own independent legal, financial, and investment advice, as we take no warranty against what you see today. Should you see anything that's different, which you've read through, feel free to put a comment through. We're happy to chat through at the end through Q&A. But I want to take you through the market view right now, and then what our view is on, of course, with the much anticipated cash rate that might go up when RBI meets on February 3rd. So today I want to cover the market outlook and also what does that mean for property for 2026. Of course, I'm going to show you some examples. I will have some past performances as well, which we've achieved for our clients when interest rates were actually going up. But please be aware that that's not an indicative of future results. So that's just a legal disclaimer to make sure that you take this information as an information only, and you do your own due diligence as we talk. A little bit about ourselves. So what we do really matters, because we're not just buying properties. We're not a typical buyer agents who are just buying properties based on people's orders. We are actually making a difference in people's lives by buying the right type of properties under the portfolio that we're building. We design the portfolio, we then deliver the portfolio, we track outcomes, and then pretty much be in the client's position to be able to get them a very balanced portfolio that talks to both growth and cash flow over a period of time, with multiple strategies to an extent of even up to 17 distinct strategies in property that we would execute along the way depending on client's position. So that covers pretty much everything, and referring it to third parties as needed, whether it's financial planners, accountants, brokers, to really get the right outcome for our clients. Now, a bit of me. FMRE Real Estate was founded in 2019, but I came in this country in Australia about 2004. So it's nearly 22 years for me now. Just about to complete my 22 years in February. And it's just been an incredible journey of being what this country could offer and the opportunities we've all been presented with. Very early on, of course, I came here to do my master's in engineering, and then post that, I worked in corporate for 13 years. I thoroughly enjoyed my journey, and I learned a lot through the corporate world. It was a big, large global organization, and I worked as a tech consultant. Grew my ranks up to senior positions, and then I really decided to do something for myself, as I had a burning desire to have my own business, but I couldn't run a standard, 9 to 5 type of shop, or for that matter, anything that just makes money. I wanted something that I've got deeply connected with people, because for me, changing lives is one of the biggest factors why I do what I do. And property just seemed to be the natural course for me, because my experience in property is now close to 25 years or more. And my first property was commercial when I was 18 years old. And since then, of course, when I came in this country, made some mistakes, bought some properties, made mistakes, and then repeated, learned the right way, got educated, and then pretty much at a point where I'm now able to obviously lead the paths and use our experience for the right reasons, and guide clients from age group of 18 all the way up to 70. So for us, the words that you see in the center, early modern retirement, is our mission. We don't want people to come and look at their retirement way at the end of it when things are pretty much tight. We want people to actually get into this when they can actually deliver retirement, and that means that we're working with clients to at as early as even in the 20s, and getting to the point that where they can actually look at 10 to 15 year horizon to see what that means for them, and what does early modern retirement look like. The reason it's early, because obviously we're trying to capitalize that at the early age. Modern, because it doesn't mean that you're doing nothing when you retire. It means that you're supplementing your income, or you do what you do best. You might still be doing a job when you retire, because you love doing that. But at the same time, what it means for us is we're able to get you that position where you can comfortably live your life and actually add on more income to your overall portfolio. So most people that we've spoken to are very comfortable with this 150,000 passive income position, and that comes with no surprise that most people are quite okay to go through this, day in, day out. If I've spoken to so many people over these years, and most of them have actually said they're very comfortable with an income of anything between $120,000 to $200,000, but on an average about 150K sits about right for them. And that means that we are doing this because we want to make sure that people can find themselves in positions where the passive income is real at some point in time, and they need to make money out of this. And it's a journey that we need to build with them. So just give me 1 second. I think I do have an interruption because the slide pack does look like it's a bit of an old one that's been uploaded. Give me one moment whilst I keep talking to you. Won't be long. One moment. Okay. Sorry. Okay, 1 second. Sorry, I just need to change the slides. Maybe this one. Give me one moment, please. Yeah, okay. Okay. Sorry, I was just trying to browse. I wasn't able to move my slides. Now I'm able to do that. Perfect. So, the passive income, and we all want to build this passive income for ourselves. But firstly, what we get caught with is our day-to-day stuff that we hear from the news channels, what's going on in the economy, and then we always have this fear factor around us, what our friends and family are saying, what social media is talking about. News channels are actually probably talking to the fear mongering, but it's more about dissecting all of that, keeping that noise aside, really looking at the signal, and really what does that look like when it comes to your goals, and trying to achieve that with a perfect step and moving forward with confidence. So tonight we're talking about market outlook in 2026 and what our view is on obviously the cash rates that we are anticipating, with RBA going to increase cash rate by 0.25% likely on 3rd of Feb. Now that all the data is out, and most people are obviously talking about that right now quite openly, including news channels, and most of the analysts are also predicting the same. We also have a view on it, but I want to walk you through the data that talks to it right now, with what's actually really why inflation is looking where it is, and what we think RBA will do. But I want to also give you an overview of a property market where it is sitting at the moment over the years, and especially in the last year and the last 3 years matters the most, when interest rates have actually gone up, come down, and now we are obviously looking to, maybe there might be another hike very soon, as I said earlier. So what does that mean to property, and why does property keep doing what it's doing, whilst we keep steaming into the property regardless of where interest rates are? So let's look at the bigger picture. The first thing is what really drives the property prices, right? That fundamentally three factors, especially in Australia. Demand supply is no brainer, but there are factors behind the demand, the supply, and of course the sentiments that are the third biggest factor that we believe drives property a lot in Australia. And these are sentiments that are obviously people's sentiments. This is consumer confidence that is linked with how people feel about property market, or in general about what people are feeling, whether they're bullish, they're bearish, or they're pretty much neutral about their views on things that they do. So consumer confidence is tracked in a metrics, and we'll talk about that in a second. But to us, when we look at the entire position at any point in time, whether it was GFC, whether it is COVID, or now after COVID, and we're going through this different economic cycles right now. By the way, over the last 7 years, since COVID or just before that, we're not in a very normal economic cycle. Things are obviously shifting quite a lot, with a lot of global uncertainty and also local uncertainty, and a lot of things have been imbalanced, but they are starting to sort of come back to their original form. Slowly, gradually, everything will start to stabilize. Events will always happen, but a massive event like COVID has taken its toll, and that's obviously taken time for the markets to do what it's doing. But more fundamentally, if I look at the economic side of it, I'm not an economist, but when I look at it, interest rates were brought down to, or cash rate was brought down to 0.1%, with interest rates as low as 1.5, 1.7% that we saw, which was a honeymoon period. And then we saw, astronomical rise in interest rates all the way up to 7% or so as well, with a cash rate of 4.35. Just very quickly, 13 rate rises in a very short period of time. And what that does is, obviously, with such quick changes, a lot of things change in the background. So right from people's ability to borrow, the demand, people's employment rate, and at the same time their ability to be able to buy properties with confidence and obviously spend money in the market as well. Consumer confidence really matters. And because, as I said, we've been in this fluctuating period and a lot of volatility with cash rates and interest rates, that changes everything. And we are not in a very stable position as such. But throughout this period, if someone has looked at the signal and not the noise, they would have made a lot of money in this time frame in property as well. And we did that too for our clients. So I want to sort of look at those fundamentals, that what we look at when we're looking at the markets right from the very top. And we look at, when we do our research, we're not looking at just directly into a suburb or property. We want to make sure we understand what's going on at a very macro level, right from what the governments are doing, what politicians are doing, what sort of incentives are coming up there, where's the demand, where are people moving, what's the population looking like in different areas, how people move in Australia. That matters because you can then qualify your demand and supply. So immigration, employment, diversity, affordability, infrastructure, all of these are very important. The taxes that people pay in particular state also matters to people. So all of that is considered to understand where exactly are we sitting when it comes to what's the outgoing going to be like and what's the incoming going to be like, and how does any policy change people's lives, which means that will drive how people will, their behavior towards either they want to live in that area or not. Do they want to change their states, or do they want to continue living the lifestyle that they desire? But at the same time, what matters most is cash flow. So we know that, for example, Melbourne has been dead for the last three and a half years, and it's really the government policies that has killed it. Has nothing to do with fundamentally about the area or the infrastructure. It's just really how the policies are. So it'll come back at some point in time. Regional Victoria is already doing very well, as we know, but that doesn't mean that there isn't enough supply, or there's lots of supply. There's lots of units in Melbourne. There's lots of properties out there. There's lots of listing out there. There's also fundamentally a lot of demand that can actually absorb that sort of supply, but people have chosen to go to other states or not buy because of the policies. So it has a lot of influence, and therefore a lot of factors really go hand in hand to drive that. And we have to look at everything before we decide exactly where are we going to position to buy properties for our clients. And that's not an easy feat. So it's very important that the three key pillars are looked at, with the data behind it, but at the same time, the experience will help qualify and make decisions on. So moving on, let's look at population, because that's a big one right now. So this is the latest, obviously, from data released in December by ABS. So we're sitting at 27.6 million population right now, and obviously gone up quite significantly. What you see there is a chart which talks about the blue line, the orange line, and the main one is the orange line, which is net overseas migration. So these are people who they're at the net levels, which means that people who have left Australia came to Australia. There's about 305,000 people as of the end of June. So about 300,000 people are coming in this country, right? Net. Now this means that if you look at the graph right from June 2005, I came in 2004. So it's pretty much covered the entire 2021 year period. We're sitting on an average, if you draw a line towards that orange line till now, you're sitting at between 250 to 300,000 people that come in every single year on an average. And that's a lot of people in this country that are flocking in, which is really good. It's the fuel for property. But at the same time, when supply is really low, that demand is driving prices up. So it's a very important number to keep an eye on. And really, with all the natural migration that is happening, plus obviously natural birth that's happening in this country, overall population numbers really matters. And then it's important to see then, where does this population really want to live? Where do they go? What are the policies driving people there? What are the migration policies where people want to live and stay? Because that will fundamentally drive the need for property. And the age groups matter as well. Which type of people are coming here? Are the families, are the singles, like, the students, more students versus actually, couples, or maybe people who want to retire in Australia. So a lot of that has to be seen. A lot of people are sitting with PR overseas, and they come back to Australia as well. And that fundamentally drives the type of properties people buy. What was there traditionally done, maybe 20 years ago, 30 years ago, doesn't mean that people have the same requirement for a property today. For example, not everyone lives in 4-bedroom, 2-bathroom property, right? There are people absolutely living very comfortably in 3-bedroom, 1-bathroom property. But as we look at properties where we live and how we like to live, we believe that everyone else wants to do the same thing, but that's not true. So therefore, we go into deep uh, and understand these trends better, so we can actually make changes accordingly and then decide the type of property, the strategy we want to buy it at, and what we should be doing. Tonight, I'm going to talk to you about in 2026 what property strategies will really work well in spite of what if even if the interest rates go up. So it'll come through very quickly. So that's the number that's looking very good, strong, and the numbers are looking very nice. So the consumer price index is now at 3.8%, which is really the CPI, the inflation that most people now know what it is. But the change is now 3.8, so that's gone up a little bit. GDP right now is 0.4 for quarterly. Average weekly incomes around 2,000 as of May 2025, and unemployment has come down a little bit as compared to last month to 4.1%, which is still sort of above 4%, where RBI would want them to be. So it's sitting at nicely above 4%. Let's look at GDP. So from a GDP point of view, of course, Australia is growing. And if you look at that, one single trend line that you can see there, throughout the year, we've had a 2.5% increase in GDP. But if you look at per capita, it's pretty flat for the quarter, but it's increased 0.4% for still until September, from September 24 to September 25. But overall, the economy, I would say, is probably still doing quite okay. There's no drastic negative impact as such. It's all it's saying is it's growing, but at a very marginal rate, and that means that it's quite stable from that perspective. Looking at where we are sitting with the unemployment rate right now, as I said, it's 4.1%, and if you look at the table at the bottom, you'll find that unemployment rate was sitting at 4.3 in November, and now that's changed to 4.1. So unemployment has come down. A lot of people are fearful about jobs, but the data is actually saying that there are more people now in jobs than there were in November. That's what it means, and that's a good thing. So what happened is when interest rates started to go up quite rapidly from November, that you can see that line going up there as a trend line. It was purposely done because I think RBI wanted unemployment to go up, because only then they can actually get some weakness in the market, which will allow for inflation to drop. And they've been very successful in being able to do that. And currently, the unemployment rate is maintained over 4%, as I said earlier, which is where we think that RBI wanted that number to be. So that's sitting quite well. Talking about inflation, this is the number being spoken about since the last, I don't know how many years now, over 4, 5, 6, 7 years, and everyone's got this eyes. And I think most people know that this targeted number needs to be between 2 to 3%. So currently, we've got an inflation sitting at 3.8%, but the trimmed mean inflation, which is really the underlying price changes that removes all the volatile price movements, that is sitting at 3.3% for December. 12 months rolling to December, which means that if you look at the bottom gray color there, October, we were sitting at 3.8%, which was on annual basis. And then the trimmed version was 3.3%. November, we were trimmed at 3.2. And in December, we are trimmed at 3.3. So in December, it's the same as October. And trimmed inflation is what RBI is interested in, not the headline inflation. So 3.8 to 3.8, October data and December data is exactly the same. Now, it is, in my opinion, it is expected that the CPI goes up a little bit in December because due to Christmas, a lot of people spend money. And of course, that is expected that there will be change. But the biggest contribution in December month has been property. So there's basket of different categories that inflation is tracked against, and property has come up at the very top at 5.5%, being the heavy weighted category. And then after that, of course, it's alcohol and food and beverage and entertainment, which sort of follows. So that tells me that property is very strong, and that has been the case for the last year. And I will go into property once we get there. But to me, right now, when I look at the December data, that was the same as October. So if RBI had to move and do something, and it was alarming for them at trimmed inflation at 3.3% in October, or headline inflation at 3.8% in October, they would have already made that change in December. But they waited for things to happen and look at the September data, September quarter data, before they would make a decision. So what they saw in December, why they did not change the cash rate in December, is because They looked at the September quarter and they said the trimmed inflation is at 3% within the range. So it was still within 2 to 3%. But what has now happened is the trimmed inflation for the quarter, which is between September to December, is now moved to 3.4%. So that's fairly alarming, which is the orange bit at the bottom that you can see on your right hand side. So June quarter, 2.7% trimmed, September quarter, 3%, and December quarter, 3.4%. And that's a bit alarming that that number has actually shifted and consistently shifted in the upward direction. And that's putting the pressure. And that's why most analysts, I believe, are talking to the rate rise that we are talking here. Yet it's still marginal. It is above the range. So if RBI gets very, very technical about it, it is possible that they'll sway more towards actually increasing the rate. If it doesn't happen in February, it may happen even in May for that matter. But sometime in 2006, pretty much in this first half of 2026, there will be one rate rise, and that could possibly happen maybe February or even for that matter, in May. We'll see. But just to give you a bit of an overview of the cash rate, where we've come so far in the last few years, and especially with such a volatile market that we've been in 1995, cash rate, which is the RBI cash rate, this is not interest rate, this is cash rate, was more than 7.5%, as you can see, in 1995. And since 1995, it's only gone down to the point where just around COVID, we had 0.1% cash rate. And then we had 13 rate rises to 4.25% cash rate. That's where we saw our interest rates to be close to around 6.5% to even touching 7% as well. And that was a very fast rise. You can see how steep that is. And if you go back to 1995 till that point, you can see that never in the history have had that sort of such a steep rise in interest rates or cash rates, which has just happened there. But when it comes to property actually absorbed that, and there was no change. Doesn't matter how interest rates were shaping, people have made significant money even during that time. And I'm going to show you some examples later. Point I'm trying to make is that doesn't matter how cash rates move, right? It does dampen the consumer confidence, but when it comes to property, it's pretty strong. And I'm going to show you that in a second. But this is important to see because we're sitting at 3.6% cash rate right now. And if it goes up in February, that'll be around 3.85, which is 0.25 difference. And that's why from our point of view, what does that really mean? So technically speaking, if the cash rate moves by 0.25% on $1 million loan, what we are saying is it adds $150 to your monthly repayment. That's the data in front of you. And that means for the month, for the whole year, we're talking about additional $1,800 with 0.25. Now, that is a real question. That does 0.25 move in 2026, which is forecasted by banks on the right-hand side as well, like CBA, Westpac, and ANZ. All three of them are in sync, and they believe there will be only one rate rise in 2026 of 0.25%. NAB being an exception, they have actually forecasted two rate rises in February and May that you can see over there. This is data as of canster.com.au. But let's go by this view that banks are saying it's going to go up, and that's fine. But my real question is, if three of the four top banks are saying there's going to be one rate rise, which is 0.25, and if it is 0.25 for the whole 2026, where on $1 million loan, your outgoing has gone up by $1,800 per year, is that really going to matter? So when you make decisions on property buying this year, you really have to put things into perspective, right? Am I going to adhere to the news channels that are constantly bombarding rates are going up, rates are going up? Or are we actually pragmatically looking at it and saying, how much is it going up by? What is going to be my view? What is going to be the change? And does that really impact me financially? Because if it does impact you financially, absolutely you need to do something about it now, right? It could be repayments that you have to relook at it, talk to your bank, your broker. You could possibly, look at maybe putting some cash in there. There are ways to sort of look at different options, change banks, whatever it might be, to reduce your overall repayments in case interest rates go up. But if that $1,800 per year on $1 million loan has really marginal impact on you or materially doesn't make any difference to you, I don't think then rest of the things really feel like it's noise. It's going to happen. It's happened before. We've had such a steep rise, 13 rises, another one rate rise. We've had 3 rate cuts last year. So one rate rise Is that going to change everything for property? Unlikely, right? And that's why we look at this data more pragmatically from our point of view, like what is the view, what is going to go on, and we are forecasting based on this view of exactly where the position we will be sitting at. So let's talk property a little bit. So this is a little bit about the fundamentals of the economics and how things sort of what's going on in that part. But what does that mean for property? It's quite clear. This was a statement released, obviously, by the National Housing Supply and Affordability Council on 21st of May 2025. We are at the point where the supply for new housing is near its lowest level in a decade. Only 177,000 new dwellings were completed in 2024, falling significantly short of underlying demand for housing, which was estimated to be around 223,000 at the same period. So in 2024, the demand was 223,000, whilst the new dwellings are only 177,000. That put a lot of pressure on established properties. And that is even true today. Whilst governments are doing everything possible, whatever they can to increase supply, I think we are far-fetched right now to see supply go up. Look, I was a first-home buyer back then in 20 years ago, and we had an issue then. First-home buyers couldn't buy properties, couldn't afford properties back then, no matter what policies came out, what incentives were given to us back then. And the situation is still the same today as well. There are more incentives now, but because prices have gone up significantly, it is still outreach for a lot of people. They're not able to get into the property, and affordability is still a question. So the supply is not getting fixed. With 350,000 people coming in every single year, the supply is absolutely not getting fixed tomorrow, next year, or even for that matter, in the next 2 to 3 years, in our opinion. Which means that that demand supply balance that we're talking about in the right areas is always going to be skewed. So this is a big factor that's driving property. It's the net migration. It is the way people move in Australia, and in the right suburbs areas where there is more demand than supply, that's going to absolutely still take properties by its storm over the next years to come. But the point is, which are these areas? How do they actually look like? What does that mean for my personal circumstances? Which property might be right for me? What is the strategy that I should be doing right now, knowing what's going on? How should I manage my cash flow? These are real questions that people ask themselves, but there are no real answers or clarity around their own situation. So most people end up going with what the market is saying, the news channels are saying, and the friends and family, or even for that matter, looking for answers on social media. And that itself is quite, in my opinion, not right, because you are moving away from facts to actually relying on someone else's confidence to do what you need to do. And therefore, roles that we play in the market is extremely crucial, because when we are talking to our clients, we're not trying to sell anything. The intention is, let's look at your situation, look at where you stand, and then talk to you about the right thing that you need to do in your situation, and with your risk appetite, with your finances in place, and then build the right portfolio for yourself. So coming back to this data here, what I'm trying to tell you is that this supply issue, as I said, the first three fundamentals were demand, supply, and sentiments. So we'll come to the sentiments in a second, but demand, supply has a profound impact on how property is doing. So I've told you about demand. Population is extremely high, and it's sort of been at the average point that we've seen over the last 20 years. And at the same time, the supply is really poor, which has been reported there. So what happens to property prices in that scenario? So Financial Review, I took this data as of Jan 7th. They may have changed their opinion by now, but I took that about a week ago, so I haven't changed that. But it is quite true that whilst cost of living concerns continue to squeeze household budgets, real estate was operating at different stratosphere, bolstered by a potent cocktail of restricted supply and government policies. That's what came out on Financial Review, and we believe that is absolutely 100% true, right? The momentum kept building up to the point that prices kept going up because there's more demand and less supply in the right areas. And there is an opinion by Craig Emerson, as you can see there, who says that house prices will continue to rise owing to the shortage and growing population. It's also our view. I've shown you the data behind it. Demand supply is absolutely working in this case as well. It doesn't matter what happens to the cash rate, interest rate, and what's going on. Now let's talk sentiments, right? This is the third pillar, which is really important. When it's 100 plus, for example, the score is 100 plus or index is 100 plus, it means that it's high confidence, right? People are actually absolutely going out there, buying things without fear, doing things. And you can see that red line, that's a trend shown from 2010 until 26. Majority of it is closing between, if you look at an average of it, between 98 to 100%. Doesn't matter what events have happened in this time frame. We are talking, obviously COVID has happened in 2020, and then we've also had GFC event that happened around 2009 and 10. So we're talking about going from very high 120, consumer sentiments down to about 100, and now averaging around between 95 to 100 over the last, 15 to 18 years. But in the last few years, as you can see, the sentiments have actually improved quite significantly right after COVID. And that's good, because that means people are confident to do what they do, to live their daily life, and they spend the money, they buy the right properties. And that sentiment matters, because ultimately it's not about a small fluctuation at a point in time, about a month or two here and there. It's about looking at the trend where things are going. So now with the news that we know what's been playing out there, I would probably think, whilst the consumer sentiment is sitting at 92.9 as of January 26, just because yesterday we've had the inflation data come in, it feels like maybe the 92.9 for temporary basis would probably fall down, because we still have RBI to deliver their news on on February 3rd. On February 3rd, let's say the cash rate does go up by 0.25, right? There will be dampness in consumer sentiment index for at least a month or month and a half or two, that you can clearly see on the charts when it actually comes out. But what you will find is that, and that's what happened. You can see when interest rates went up quite dramatically between the May to January 22, all around that point in time. That's when interest rates started to go up quite dramatically, and consumer sentiment dropped from 120 down to about 80 before it started to rise recently. So when interest rates go up, there will be dampness on this 92.9 index that we are talking right now. And I will not be surprised if it goes back to 90 or even 89 in the next 2 to 3 months as interest rates go up, if at all that happens, which means that for a temporary period, that consumer sentiment matters in markets. But what does that mean for property? In property, it takes time for the market to absorb the consumer sentiment. It's not like if there is a drop today, there'll be a drop in property prices today. Okay. That takes time, because property takes time to absorb changes that happen. It's not like share market where, something happened today, suddenly you'll have a crash in stock market, or you'll see 30%, 20%, 15% prices down. Property doesn't work like that. By the time things reach property, and the sentiments reach the property side, which means there's more supply, less demand, we are talking a few months away from now, right? So in the context of what I'm trying to say is, we are end of January right now. In February, if the rate goes up, you'll have February to March or maybe April period where consumer sentiment might be dampened. People get adjusted to the new way of their cash flow positions, right? So if there is a 0.25 increase, as I said earlier, on a $1 million loan, we're talking about $150 added to your monthly outgoing, which means that's close to $1,800 a year. So now in 3 months' time, you have an extra $450 that's going out of your pocket. Does that really going to matter much? Because after 3 months, if there's no more further rate rises, things are not happening, you're going to forget about it, and the 450 get absorbed in your outgoing somewhere, and things get back to normal, and consumer sentiment starts to rise. And that is typically what we have experienced year after year, which means that property will still doing what it's doing. We all have to live. We all have to go and stay somewhere. We all have to, move around. We need rentals. We obviously need to buy properties. People need housing. That's real. So life is not going to stop, and people get really adjusted to this new interest rate, that if at all that happens, which means things go back to normal. And therefore, whilst the sentiments are an important pillar, in this case, whilst banks are forecasting, or most of the banks are top 4 banks, 3 out of 4 banks are forecasting only 0.25 increase for the entire year. And if I go by that view, it's hardly going to matter when it comes to property prices, right? So let's look at the current state of the market. So I'll give you a better perspective, right? Property is $12.3 trillion market, right? And this is not a small amount. We're talking a loan to value ratio. Most people say property is going to crash. I've never seen crash in property right now. And I'll show you a chart right now over the last 50 years, what's happened, but that's not the case at all. 20.3% properties that are actually there in the market out there have loans on it, right? The rest of the properties don't have a loan on it. So it's not going anywhere. 55% of total Aussie household wealth is held in residential property. That's huge. And that's why it is too big to fail. This is why nobody would want property market or to crash at all. Not even banks, not government, and not even RBA for that matter. This is a play economically. They need to balance. They need to pull the levers, which is what they'll keep doing and will keep happening. But property is resilient to all of this, and you can clearly see that it's 3.5, 4 times bigger than your superannuation and listed stocks in the SX 200, which means that property is so big that every second person is linked with it. In fact, it is the biggest employer in the country. So, keeping this perspective in mind, we have to understand that it is too big an asset class to play around with, where things will go volatile on it. Now, I'm trying to now bring that view into what's happened since 2015 to 26 right now. And it gives you a good understanding about the rate of growth across different, obviously, states as well. And I've sort of marked them down to I've categorized them or segmented into the things that have happened and how property has influenced. The y-axis here is actually the rate of growth. So it's not that the prices are going down. If you see anything going down, it's actually saying the rate of growth is going down. So read it that way. And then, of course, you got the timeline. So I'm going to focus on COVID point of view, and you can see what's happened there, right? You can see all markets in COVID actually went down, but went down for a very small period of time. When, of course, interest rates were around, or cash rate was around 1%, down to 0.1%. So as cash rate went down, because obviously we saw that happening in real time, those who were here in 2021, 2020 as well. So COVID rate, cash rate went down. We saw interest rates were falling, but look at the property price. As soon as interest rates went down to less than 2% or so, markets started to swing really, really, really quickly. But what I'm trying to focus there in the very first segment there is that the downturn was very small, although the COVID was one of the biggest, largest event that any humankind has seen in the history, right? And it was quite dreadful at that point in time, as we've all been through it now. But when you see property, what you see across all states is that the rate of growth was hampered, but the property prices didn't matter much. They were still holding really well, especially in the outer areas. And it started to go up quite significantly right after that, because that 0.1% cash rate was there to hold for at least 2 years or 1.5 years until things stabilized. So we saw property run up, and those who made money, they made really good, serious money during that time by buying and taking action at the right time. Then what happened was, and in some states we've seen, where, for example, Perth has done nothing since 2010. This is only showing in 2015. I came in 2004, so I know Perth market, how that's performed. It was really dead for many, many, many years. In fact, almost nearly 2 decades. And then it started to catch up really, really quickly, just around COVID and after COVID as well, with the other national prices as well. So some of these markets have been more of delays and trying to catch up. Others have been consistently growing at 5 to 7% or maybe 8%. But what's unreal is the growth that we saw during COVID or just after that, because of low cash rate or interest rates. So some markets have even gone up 25, 30%. This is at the state level. So if you look at the property level, the properties have almost doubled in 3 to 4 years in the right areas. And we've seen that for some of our clients. So we made a lot of money for clients in that period. And that's a good thing. Now, when the cash rate started to go up from 0.1 to 0.1 to 4.35%, those 13 rate rises that I'm talking about earlier that I showed you, that's when everything dipped, because it's such a strong spike in such a short period of time in the history that we've seen in Australia. It actually meant that people were not able to keep up to the repayments and everything had to drop. So again, what you see there is that a lot of markets, obviously, there's a sharp decline in the rate of growth, but then there are markets which actually took it very seriously, which is Sydney, Melbourne, and you can also see Hobart as well, to that matter, even Canberra. So they all had a hit, but again started to recover back again as soon as the cash rate stabilized on 4.35% for another 2.5 years. And you can see there that the prices started to rise back again, because people got used to the new way of actually spending that money. They knew they had less money in their pocket. Whatever they were holding, they got used to it, and the life continued the same way, which means now people who were going to buy properties. They did buy the properties end of 23, 24, and the prices started to rise. The rate of growth started to rise, regardless of where the cash rate was. So during the period of no change, there was no change on cash rate. We have seen the rate of growth continue to happen, as you can see in that third segment. In the fourth segment, we again saw that was last year where there were three rate cuts. And again, whilst things were starting to fall down, it started to rise back again. And that's how you see these things. And this is what I meant earlier, that we are not in a very stabilized economic conditions. The market growth rates are shifting based on what's happening with interest rates, what's happening with cash rate, and what decisions are being made both at the federal and state levels as well. So it's quite important that we look at the macro picture before we do anything. But it doesn't matter which period we're talking about, what you see here on the screen. If you choose the right market at the right time, doesn't matter what time it was, you would have still made money. And that is the key point here by showing you the history there. And we can see that nationally, when we actually look at some of the suburbs and look at the rest of Australia, like regionals have done phenomenally well over the last 7 years. In fact, they're at a point at par with where metros are when it comes to rate of growth, and in some cases, phenomenal double-digit growth that we've seen for clients. Even in Victoria, over the last 12 months in regional Victoria, we invested for clients, and for example, December 24, and for 12 months from December 24 to December 25, what we notice is that in some markets have even posted 20% growth in Victoria. It's almost unheard of, right? When Melbourne has been dead for the last 3 years, as we know, and even now it's a bit sluggish overall from Melbourne. So Metro is not doing that well in Victoria right now, but some of the regional Victoria markets are doing very well right now. So you really need to know, because there are markets within markets, there are 15,000 suburbs, and not everything is going to move equally. So it's very important that diversification is looked at different states, different levels, regionals, metros, whatever capacity you have. But as much as diversified you are, you're going to make money accordingly, because none of us know where the markets are going to land. But at least if you know, you use the experience, you use the data to your advantage, you can make right calls on what markets to actually invest in. And it's quite clear over here. You can see the 12-month and the 3-month change. The markets are only going up. And this is the data of the last 12 months when interest rates were coming down. And Australia has done phenomenally well. Capitals are 8.2% up. Regionals are 9.7% up. That's what I was trying to say, that regionals are doing very, very well. WA, South Australia, Queensland continues to, take it by its stride. We've seen NT suddenly didn't exist. Suddenly Darwin's coming from nowhere. Basically, again, like Perth it did a huge catch up just after COVID. Right now, we are seeing now Darwin doing that and just trying to catch up. Fundamentally, I'm still not very confident about the market to give you a sustainable growth over the years, but that's the current data that we see. So we've seen now Hobart as well pick up really, really well. It was down for 2-3 years whilst interest rate fluctuations were happening, but now Hobart and Tassie is showing strong signs of recovery, which is really good to see. Month on month, the data is improving. Although, depending on your strategy, the goals that you have, it may not be the right market for you. But overall, if you see the picture, everything, all the bars you see on your on the screen are towards the right, except for regional NT, which means that doesn't matter which market you were in. If you bought at the right time, you would have made money on this. We've seen 15% to 20%, even in some cases 25% growth in 12 months for our clients just in the last 12 months alone. This data tells you exactly by segment. So this is really important to understand that in any given market, there is a price points at the lower side of it, and there's price point at the higher side of it. So you'll find properties in a suburb for $500,000, and in the same suburb, you might find properties at 1.5 million as well. So that's the range that we're talking about. The prices sit in the particular suburb, for example, and that's segmented to the way you see it on your screen. The first 25th percentile, the 50th percentile, and the 75th percentile. As you can see across the states, that the majority of the growth or the rate of growth has happened always on the lower side. So if you buy a 500K property in the same suburb, that's bound to grow more as compared to 1.5 million, because you have more demand for people buying properties at $500,000. Hence, in FMRE real estate, we have always looked at this from that perspective, that let's keep the investments at the lower price point as much as possible in every state, so that it has maximum chance to grow. And we've seen that year on year over the last 7 years since we've been in operation, and it's come out absolutely clean. The data talks to it. We're doing it. It's a core strategy. We are not of the opinion of buying $2 million property when you can buy four properties like that. So it's all about diversification and ensuring that there's more buyer, more demand for your property that you buy than actually looking at something which is more premium in the area. Then we're talking national sales. Now, this is an interesting chart because we've seen sales go up 4.9% in Australia. Capital regional sales is 8.1%, whilst capital is only held at 3.2%. That's amazing. That's like saying more and more people are investing in regional, right? And more people are buying in regional. This could be home buyers moving, people moving into regional areas because of affordability. And therefore, we've seen a significant rise also happen in regional. So this is a really good result, but there aren't too many developments happening in regional areas. So these are all established stock that we're talking mainly, which means that that puts a lot more pressure when there's high demand, low supply. But we need to be in the right market to buy even in the regional markets. Not everything is equal. Listings, overall listings are at extreme low, 15% lower than a year before. And you can see that here. And compared to 20, it's a 5-year average, it's 20% lower. Which means that again, supply is far lower than demand, and that's constantly pushing prices up. This has nothing to do with cash rate. This has nothing to do with inflation, has nothing to do with interest rates. This is really supply and demand of property. More people in the country, less properties available to sell, more demand to buy, and at the same time, low developments or less development means more demand to buy properties, and that clearly shows you right there on the screen. Doesn't matter which year you take 23, 24, 25, the trend lines are the same, but it's only getting worse with listings available to buy properties. We are also, it's getting harder for us as well to find the right properties because we have such a huge list of due diligence checklists that we do. So if in an area there are 50, 70 properties available, we might only be picking up a handful of 5 or 6 to even look at before we even start doing due diligence. So that further reduces what properties we are picking up in the market because we want to make sure the quality is still delivered. So exceptional results don't happen just by accident. There's obviously there's a lot of work that goes behind it. There's mechanics behind this process. There's defined ways of doing work. We instrument everything that needs to happen to make sure that we understand markets, we understand property. We have our own research team that's doing things in the background, and we understand that better because we can overlay experience and over data and make decisions based on that. Most buyer agents you will see in the market, they're doing what they're doing, but they rely just on tools, reading the data, and they'll make decisions. It's not the right way to do it. You have to overlay the forecasting aspect of what we think will happen based on the experience and the data points that I've today spoken to you about overall. So it's critical. Looking at the rental market, very, very strong. All areas have done phenomenally well with rentals, and annual changes have gone significantly high. As you can see, overall at the Australia level, we're talking about national rental rise by 5.2%. And we can see that very clearly it's starting to rise again. It was quite high earlier in December 2021, but now it's again starting to rise. So low again, as I talked about demand supply for buying, there's also a problem even for rentals as well. So in the right markets like regional WA, it's 10% increase in rentals, and Darwin is 8.2, Hobart 7.2. So we are seeing an annual average return of around anything between 6 to 7% rise in rental values, which is really good across the states that we are buying properties right now. And that means that even if you start with a negative position on a property, at some point in time, if this trend continues, you'll find that in few years' time, it starts to blend your negative position, even though interest rates are hovering around 6% right now. So that perspective is important to keep, because what you see today when you buy a property and it's negatively get, it doesn't mean that the same number will stay as it is for the next 5 years. It will change because rents will go up. So keep that in mind. And of course, your loan is coming down if you're on principal and interest. These are rental yields, so we talked about that in a second. Now, this is where we are seeing the rental markets take by storm. So as you can see, the unit markets are also doing very well when it comes to rental, and so is houses. So a lot of people are pivoted towards reducing negative gearing and buying units as opposed to houses, because not only you're spending less to buy a unit, the yields are also a lot higher in units. When I say units, we're talking townhouses or apartments versus actually houses. Now, be very, very, very careful. Just because your cash flow looks better today and you're making a decision to buy a unit, that's a big warning, right? Not everything is equal. There is a lot of supply when it comes to townhouses and units. I'm not saying they don't grow. Some of them do really well if they are positioned well in the right place, but you really need to know what you're doing with units. The forgiveness in the unit market is far lower as compared to houses. So if you've got something which is independent with a land and a sizable land size, it's always going to do better over the years as compared to unit markets. A lot of people have burned their fingers. If you are going to take a stab at a unit, be sure you know what you're doing and understand demand supply better. All right, so I'm going to move on because we are sort of running out of time as well. So I want to make sure I cover what I feel we should be doing in 2026. So firstly, review and adjust your portfolio, right? Keep the outlook that there might be a rate increase, maybe one or two this year, don't know, but keep that in mind and put that into perspective when it comes to your cash flows, right? And look at the opportunity cost is also equally important, because if you did nothing in the next 6 months or even 12 and you just sat on it for things to get better, look at their opportunity cost. What does that mean when it comes to prices? The way you've seen prices go up right now, what you buy for $500,000 today will only be 550 in a year after. And that's just an example, but are you prepared to pay something for 550 that you could possibly buy today for 500, for example, right? And that's the opportunity cost we're talking about. Sitting on something that's not working for way too long before you're taking action to buy something that's actually going to make more money for you than sitting on something that's almost dead, right? It's very important to look at that opportunity cost. Secondly, focus balance on balancing your growth and cash flow. So if you've got too many residentials in your portfolio, look at how you can add incomes to those residential properties, but at the same time, how can you change strategies or maybe repurpose some of the assets to buy more cash flow strategies. So what we believe will work really well for people who are, obviously cost of living has gone up as well. So we are focused a lot right now into commercial rooming houses, short stay type Airbnb properties, or buying block of units that's giving you better rents, although with a good land size. So it's not a single unit, it's not a townhouse, but a block of units that's sort of giving a sizable return. Buying and holding properties in regional, maybe renovations and holding properties, or maybe renovations and flipping properties, so you can have some cash flow on the side as well. These strategies will actually make sure that some of these rises that are anticipated, you might be able to weather that very easily because you've got cash flow to back yourself up. And it's very important that cash flow is managed as you sort of buy properties, because that's the last thing people focus on, and they get into the point where their lifestyle starts to impact. So you don't want that. Now, I just wanted to very quickly show you, we've had phenomenal results over the last 7 to 8 years, for our clients, but these are just from the last 2 years. And you can see in 14 months, 12 months, 18 months, doesn't matter which state, because we buy all over Australia, we've had some significant growth, close to 60% in 14 months, 23% in 18 months. Recently, I just did a review for a client who bought a property in Queensland whilst living in South Australia. That's 25% up for a man who is 57 years old, looking to retire very soon. Sorry, 55 years old, looking to retire in 58. And then we've also looked at situations where people have actually bought multiple properties with us, how their portfolio is done. So on their cash of the amount of money they've spent, some people have even made 100% return on their cash on annualized basis. That's phenomenal, right? Where do you get 100% return on your cash? If you know any other place, I would love to know. But in property, we know how to get the growth. We know where things are sitting at, and we know how to balance that with cash flow. So it's very important that when you're looking at it, as an example here, we've had a Sydney client who bought property back in Perth for us about in November 23 and September 23. So this is when interest rate was still quite high. We bought something for 492,000. I think it was 3 bedroom or 4 bedroom. I don't remember right now, but it was a beautiful brick house. And $492,000 property in 18 months became 668,000, and in 24 months, it was 754,000. So this couple also interviewed 11 BAs, and they chose us to help them buy this. A 53% growth in 24 months. So purchase at 492, final value at 754 as of October last year. We've still had another 3 months right now, almost, which is November, December, January. If I take the latest data right now, I would easily find that this has gone up even a little bit more. So this data is as of October 2025. But that's a phenomenal result. Where do you find properties going up 50-60% in just 2 years? It's just incredible to see a result like that. Another example, bought this in 24. So February 24, We bought the property, which went up 20 months. It went up 29% in value, literally just in 20 months. And you can see that data was also taken on in October 2025. Again, this would have notched up a little bit more, but in 2025, when we bought these properties for them for 455 in February 2024, it went up to 587 in October 25. So that's an uplift of $132,000, and the rent is up from 540 to 570 as well, which means the negative position starts to dilute. But on a 455k with a rent of 540 starting position, the negative would have been very, very small. And with rents going up, that's also diluted further. So you have to really keep this in perspective, that what you're doing is buying at the lower end of the range where there's more demand in the right market. That's going to get your property prices going up quite significantly and quite quickly. So this is again another Sydney client who bought a property in Queensland. And there are examples after examples. I can keep going on it. Here's an example where we bought 5 properties, 3 residential, 1 commercial property, and then the fifth one we actually converted a house into an Airbnb. We suggested that to buy in the right area to buy an Airbnb. So on a 2.7 million spend on 5 properties spread across the country, within 24 months they have a 500k equity built very quickly with a value of 3.2 million now, and there is a positive net rental income that we are expecting to be close to $27,000 even in this high interest rate market right now. So for these people, even if the rate rise happens, right, because they have positive gained income right now, which is 27,000 on just from 2 properties that they have there, it's almost negligible. And the remaining 3 properties that they own for over a 2-year period, most of those properties are nearly breaking even. So it hardly matters. They can sustain the portfolio even after 2 years. Doesn't matter whether rate rise whether it would happen or not happen. So building portfolio, spreading that with different strategies, diversifying across states, and buying good sustainable assets that has got land content to it and robust properties will give you a robust result in your portfolio. And this is not an easy feat. It requires designing the portfolio, putting the vision together of where the goals are for the clients, what are they trying to achieve in 5 to 10 years, how much passive income do they really need, and then which assets and where are we going to actually pick these assets that's going to deliver results. And that means we are instrumenting deals to people's positions in the right way and buying right properties that they own for the generational wealth that they're building and the early modern retirement that we are so passionate about as part of our mission. And then commercial is just a piece of cake for us. Like, buying something which is a medical center to buying restaurants with a unit, buying multi-tenancy, buying 5 tenants in one single property or 2 tenants in one single property with high rental yields is definitely what keeps us going all the time with good returns. And this is another example, as I talked about Airbnb earlier. This is the property. If it was rented to a normal person, you would be negative 10,000 cash flow. But because turning the same property into an Airbnb strategy, that's giving an $8,000 positive cash flow. So it completely shifts your cash flow position by changing strategy. And that's a great result to buy the right property. In this case, the occupancy rate is nearly 70% based on our analysis. And we've taken a very conservative average nightly rate of 290, whilst we think that 350 would be quite easily achievable in a renovated property like that. Plus, it's got subdivision potential, 800 square meter block, 841, and you can see across the road they've already done unit development, which means if I put 3 units here, demolishing this one, you could Airbnb all 3 units essentially and make even further income. So you have to find how to stack strategies, how to get the right thing going. How do I make money from a single property rather than buying 10 properties? Can I do something more just from a single property, right? And that will give you far better results. And by the way, just to get a passive income of 150k going, you don't need 10 properties, right? You don't need too many properties. You just need the right properties, and you need the right strategy behind those properties that's going to make you money every single day. Here's one example. We converted a 3-bedroom, 1-bathroom property, sorry, 2-bathroom property into apologies. This was a 4-bedroom, 1-bathroom. We turned it into 5-bedroom, 2-bathroom. So another bathroom was added, another bedroom was added. But this was purchased in COVID. We bought the property for 312,000 on a big land on 695. We changed this property into a rooming house. So basically, instead of having a single tenant, this property has 5 bedrooms with 5 tenants in there. That means it actually delivers cash flow day in, day out. In fact, in 2022, financial year 2022, this property delivered 21,000 in passive income. And the client actually paid $8,000 tax from his pocket on a property like this. And he also says he gave us a Google review after 2 years keeping this property in this position, and actually then gave us a review because he really wanted to see the cash flow was real. And he mentioned dealing with Anubhav has been like reading Rich Dad Poor Dad all over again, except it's having someone implement the book for you. Now, this is not, we don't take this lightly. We are super proud about this particular review, but at the same time, results like this, over the years, when we see this property has almost doubled in value, $312,000 property is now sitting at around 500, 550, and the cash flow continues to keep going up because rents are going up. Of course, costs do go up as well, but the property does not cost the person anything. And at the end of it, once it's all paid off, you're anyway enjoying more returns on a property which is less than half a million. I mean, that's phenomenal. How many properties do you need to buy, before you can get net passive income of 21,000? So keep that into perspective when you're collecting assets. It's not just about holding assets, it's buying the right properties, and with strategy. All right, so here's a recap. So population boom, we've had 420,000 people in June, annual growth rate of 1.5%, and we saw a net migration of 305,000 as of June 25. We have a low housing supply. As we said, we showed that prices are up almost 8.6%. Rentals are up. The rental people are paying is 33% of the disposable income, which is quite high as well. Lower unemployment, that's gone down a little bit as compared to November, which is 4.1%. Consumer sentiment is still sitting at 92.9, which is quite high. It's higher than January 25, which is really good as compared to last year. Government incentives are still there, very strong for first home buyers, and there are a lot of buyers in the market out there looking for right properties, trying to capitalize on government incentive, which is really good, which means there's more demand. Finance lending is tightening, but it's got less impact on what APRA has come out with. Only 20% new loans will be given to people who's got their DTI over six, which means that pretty much what we're saying is, if you earn $100,000, you can only get a loan of up to 600,000, but that's only for people that it's only, and they'll only give loan to 20% of new people, or new loans will only be 20% per bank, and I think it's quarterly as well. So you can read a little bit about that more on finance side. I'm not a finance guy, but based on what we understand is that it does not have a lot of impact on normal borrowing for people in this market. Trimmed inflation 3.3%, so that's December monthly data, which is what we saw. And of course, if you're buying in Victoria and South Australia, keep in mind there are state elections happening. In South Australia, it's on 21st of March. And we are looking forward to the Victoria one on 28th of November and seeing what's going to happen. It's going to be an interesting turn. And I do believe that there will be change in housing policies, which should come up before when the campaign starts, because both parties will be quite motivated to do something with the housing and property, in my opinion. If they want to win election. So it should become better, and hopefully, our pain is reduced in Victoria. But let's look at a bigger picture right now, and this is really just sort of closing in. If you look at 1970 data all the way up to now, the green line is where the property prices are at Australian level, right? It's only gone up, doesn't matter. And the red bars are the decades showing that. So home loan percentages have shifted 6.5% to 10%, 10 to 17%, 7 to 6.5%, then 6 to 9, then 5 to 7.5. Inflation has also changed along these years, but the house prices decade on decade has only gone up in this country. We are not same as Canada. We are not same as US. So don't compare to other economies. We are very differently positioned. And when it comes to property, we're absolutely killing it right now. And it's going to continue to keep happening. Nothing has stopped. You can see the green line there. That's a historic view. Doesn't matter what has happened, whether it's recession, Olympics, GFC, whether it was APRA coming in and stopping everything, putting a cap on lending, or it could even be COVID-19. Nothing has happened. Nothing has stopped us moving in the right direction. When it comes to property, it's all about your mindset. It's all about your consumer, your confidence, consumer confidence, and the strategy that you're going to use to be able to buy the property. That's number one thing that you got to look at. So here's our view. Cash rate is likely to be up 25 basis point to 3.85% in February. If not February, it will be May. And national property annual growth is likely to be around 5 to 8% in 2026. With some markets, we believe will still deliver double-digit growth this year, around 10 to 15%. And this is an opinion. Please don't take this and go and buy things yourself. Do your own due diligence, as I said earlier. That's a disclaimer that I read out earlier to all of you. So make sure you look at in your own lens with your own risk appetite. This is our view of property outlook. We'll see where the year ends, but we are quite bullish when it comes to property, regardless of what's going on with interest rates as such. Now, if you really don't know what you're doing and you really don't understand, you've seen all this, and if some of this has really moved you today to look at the things the way we look at things, I'm doing a free property portfolio review for clients, and this is only for very limited 5 spots only, which is valued at $3,300. I will give you my 45 minutes, and this will be booking an appointment with me directly, and I will review your portfolio. So if you're sitting on opportunity cost, you really don't know what's going on with your portfolio, you have no idea, you have no clarity, you don't know if 2026 is your year, book that session. I will give you free advice based on my experience, what you should do. I'll give you options, what you think will be right for you. I'm not a broker, I'm not an accountant, I'm not an economist, but I'll be using my experience to talk about your portfolio and what I think you should do with options so you can move with confidence. Only 5 spots, and it's going to be first in best dressed. So first 5, that's it. If I see more appointments happening, I will unfortunately not be able to do that unless we charge for a strategy like that. But this review and strategy session will help you understand things better. So only top 5 spots. Please go book there. It's on findmyrealestate.com.au. You can go and book on consultation or /Anubhav. If you just put there, you'll be able to talk to me directly. Now, if you want to stay in touch with us and you really want to know more things and keep in touch with our experience, what are we thinking about property, what's going on, make sure you join our Facebook group, which is called I Love Property, and or WhatsApp group as well. And of course, this is being going live everywhere. It's on different platforms. You can take a snapshot and then later on scan, or there are links given over there. This will help you improve your understanding, your knowledge, as we talk through different strategies. We bring in deals as well. We post deals sometimes as well on our groups, so that you can look at it. What are we buying? But ultimately, everybody wants to make money. They want to build wealth for themselves, for their family. Then you really want to be associated with the right groups to be able to grow together. That's it. Thank you very much. As I've written, the success leaves clues, but you've got to take action. So 2026 year, make it count for yourself. Buy with confidence. If you really don't know what you're doing, we are here to help, and we can definitely take this forward for you. Now, I'm just going to be taking some questions if there are any questions. I don't see any questions except from hi, hello, everything, which seems like I've covered this quite well. If you've got any questions, please feel free to post something. I'm happy to answer that for you right now. I'll keep this slide here to book a session with us, which will help you sort of if you haven't taken action, but you can do so. So I'll wait for another maybe 2 minutes. If there's any questions that are coming along that I'm happy to answer through, please key in your questions. If not, we'll call it a night. Okay. Looks like there aren't any questions, which is good. So thank you everyone tonight for your time. I hope you really enjoyed the evening and the session. It was packed with data, but my analysis I've shared and my opinions very strongly today. So this comes with experience. I'm not an economist, as I said, but hopefully this will deliver at least the right message to you, so you know how to look at your situation and your portfolio before you take action. But make this year count, because that's what matters. So thank you very much for listening. We'll come back with more webinars, and we'll keep doing that throughout the year. Thank you very much.